CNBC TV18, celebrating 15 years of leadership.
Welcome back. Here with markets today. This week hasn't been good for the equity space. Key indices have lost about 4% apiece. Realty, cap goods, oil and gas, these have been the sectors that have hurt the most. And it's not just the equity space, but even the currency. The rupee has actually fallen to a 10-month low. Anand Narayan at Standard Chartered Bank, who we spoke to earlier this morning, says that he's not unduly worried about this correction in the currency.
This is a kind of an expected correction in the rupee. The reality is, since June, July of this year, we've seen a significant amount of dollar strength going through across currencies. A few currencies have bucked the trend, including the Indonesian rupiah and the Indian rupee, for a variety of reasons. Now, at some stage, the RER has to catch up. At some stage, the interest rate differentials and the growth differentials have to catch up. So to that extent, the kind of gentle depreciation we are seeing in the rupee is in a way a welcome step. It's not really a problem for any of us in the market participants. So I think this trend will continue. Levels, you could see a 63 level being tested. At 62 on the downside, you'd probably have, Indian banks and the RBI mopping up dollars. You could see a move up to 64 in the middle of next year. Again, gentle depreciation, catching up with the other currencies across the globe, making sure the RER doesn't go completely overvalued on the rupee is good news all around.
All right, that's the Stancy view on the rupee. Let's move back to equities now. Sudarshan Sukhani is joining in. Sudarshan, it's not been the best week for our markets. Do you expect this volatility to continue haunting the markets? How are you reading the picture?
Good evening. Well, the markets had another down day today, and this is becoming a habit. Not only was it a down day, we've also come back to 8200 from where an earlier gap up had taken the Nifty all the way to 8600. So we are on the verge of closing that gap now. Not filled it completely, but the very fact that a gap is being filled is not good news for the bulls. We have been suggesting that we are in a short-term downtrend. There is only one trade. Either you go short or you step aside. And the market seems to be agreeing to this. That position continues. There is a short-term downtrend in the Nifty. No signs that the downtrend has come to an end. It can give us a V-shaped reversal and we have to accept it. Our levels earlier were 8450. We bring it down to 8400. So far as the Nifty trades below 8400, the trend remains down. And short-term traders, as I said, should be on the downside. Intermediate traders should have gone short below 8490 or should have stepped aside. Since it is a correction, if they haven't gone short, nothing is wrong. But they should not be buying now. That's important.
All right, Sudarshan, but for Monday morning, is there any long recommendation, perhaps from the frontline space, that you could give us?
Well, while the trend remains down, there are defensives which are doing much better, and Sun Pharma is one of them. After a sharp correction, and that correction was coming when the Nifty was going up. So now maybe Sun Pharma can now begin an up move while the Nifty is coming down. After a sharp correction, Sun Pharma is building a base. It's also giving the impression of a bullish head and shoulder. Not confirmed yet, but could be confirmed. So for Monday, consider buying Sun Pharma. It's a defensive, relatively safe stock. But markets can do anything, so keep a stop loss.
All right, Sudarshan, many thanks for that. You have a good weekend. We'll see you with the markets again next week. Let's move on to macros. Well, come Monday morning, and the market's going to be looking at two more important pieces of data, both IIP and CPI. Ekta Batra is here with more. Ekta?
Well, between the two data points, it was definitely the October IIP data that was disappointing. But I'll start with the November CPI data. That one came in at 4.38% versus estimates of 4.4%. The core CPI softened as well. It came in at 5.5 versus 5.85% month on month. Now, the reason why we saw the softening coming in for CPI was one, because of a favorable base. In November 2013, the CPI was above 11%. Besides that, we had food inflation, which lowered quite significantly. It came in at 3.1 versus 5.59%. Vegetable price showed a disinflation of 10.9%, and fuel light inflation was similar to what it showed in the previous month. So that came in at around 3.27 versus 3.29% on a month-on-month basis. So that's on the November CPI data. Turning to the IIP data for the month of October, that in fact shocked quite significantly because that came in at a decline of 4.2% versus expectations of a possible growth of at least around 2.1%, and this compares to a growth of 2.8% in the month of September. Now, what really disappointed was possibly an aberration this time as well. Now, most of the economists believe that due to the shutdown of the Nokia plant, the plant itself shut down in October, that could have resulted in a one-off that we saw this time round in the IIP. So, for example, that is correlated to radio, TV and communication apparatus, which declined 70% year-on-year. And remember, that has weightage of around 9.9% in manufacturing, which itself declined 7.6%. So remove that, but it is still a sluggish number. It's still a decline of 0.2%, even after the core sector grew at over 6% for that month. So what really disappointed was consumer durables, which contracted 35%. Totally, consumer goods, because of that, was down 18.6%, and that has 30% total weight in IIP. So overall, it is still a disappointing number if radio, TV and communication is even removed from the total data. Overall, IIP was disappointing, CPI was in line.
All right, Ekta, thanks very much for that. Now, India's largest IT player, TCS, has sent off waves of caution through the sector. Speaking to analysts in their quarterly call, TCS says that they've seen some slackening of momentum and warns that Q3 revenues will carry the negative impact of seasonality. Kritika Saxena is here with the highlights of that call. Kritika.
So, to put things into perspective, Q3 is typically a seasonally quarter, yes. But what TCS has said this time around is that the sentiment seems to be more negative. So, while the seasonality will impact the company in terms of revenues and in terms of balance sheet figures, the negative impact will hit the company more than expected. In fact, what they have said there that the earlier momentum that they were seeing in the IT market seems to have slackened, and that they are now not as positive as they were at the beginning of the year. Remember, at the beginning of the year, they had categorically said that FY15 will be better than FY14, but that doesn't seem likely anymore. If I had to break this up, they've also said that dollar revenues is likely to be impacted by 220 basis points due to a cross-currency impact. Let's break it up into sectors now. BFSI is expected to see a hit, largely because of weakness in insurance, which was seen last quarter as well. Retail, manufacturing and high-tech are seeing seasonal furloughs, and the insurance weakness possibly could continue going forward as well. Geographically speaking, Europe and UK is expected to be weak. India, the issues as far as domestic toughness is concerned in the business will continue, but US should be in line with expectation. The good news is that pricing trends are fairly stable, and that the margin target band is 26 to 28%. So all in all, Q3 will be more negative than what we were expecting, and this is a clear caution wave by the company, sending out a big question mark that would other IT companies, and would Q3 be a bad quarter going ahead, and possibly is the weakness back in the IT market?
All right, Kritika, thanks so much for that. Let's see how the TCS stock reacts to all that commentary on Monday. For now, let's look at what else we are watching out for next week. Varinder Bansal is joining in with the key highlights. Varinder?
Well, clearly, markets will be reacting to TCS on Monday. That will be one of the most important stocks to watch out for. But on Monday, also watch out for US industrial production numbers. Keep an eye on India Cements, because Supreme Court will be hearing a case against Mr. Srinivasan. Insurance bill will be tabled in Rajya Sabha, so keep an eye on Max India and Reliance Capital. Tuesday, FOMC meeting begins. Keep an eye on Hindalco, because special court has a reserved judgment on Hindalco closure report. That could be out on Tuesday. Also, government will be considering 31 FDI proposals on Tuesday. On Wednesday, FOMC meeting announcement will be coming in, so the markets will be reacting on Thursday. HICL board will be meeting to consider stock split. HOEC results will be out on that day. Thursday, I said, markets will be reacting to FMC announcement. Also, India Glycol, a small cap company, board will be considering segregation of rental business. SAT will continue to hear DLF versus SEBI. So DLF could be important stock to watch out for. And Friday, last day of the week, it's the day when final arguments in 2G spectrum allocation case will be heard in Delhi court. So keep an eye on that. But I believe that FMC announcement could be the most important cue next week if you're watching out for the global data.
All right, Varinder, thanks very much for that. We'll keep our eyes peeled next week. Now let's hear out some top trading ideas from our experts.
I think, even after the last, 4 or 5 days of selling pressure, this is one of the few stocks which is still maintaining its, upward trajectory. It's very close to its resistance level, not typical of those stocks which have corrected, more than 10 to 15%. So I think there seems to be some chance that, Canara Bank may start its or may resume its uptrend. I'm looking at a target of close to 440 on Canara Bank with a stop loss of 415 on it.
Stock where you could take a long position is of course the defensive space. Oro Pharma is broken out on the charts. Can be looked at with the first target of 1195. One should put a stop loss at 1140 and go long.
ITC has already given a flag breakout after 3 months of consolidation, and that transforms into a price target around 440 to 450 on the higher side. But in the short term, we are expecting the stock could test levels of 420 to 430, and then it could enter into a consolidation zone. Now the uptrend, short-term trend would be reversed only if the stock manages to move back below 380 levels. So keeping 382 as a stop loss, we recommend buy at these levels with a target of 420 in next 3 trading sessions.
All right, that's the end of Friday, and that's the end of a week that the bulls would definitely want to put behind them. We'll see you with the markets again next week. Thank you for watching.
All right, bye-bye.
CNBC TV 18, celebrating 15 years of leadership.